One of the most remarkable changes in 2025 is the US dollar losing its safe haven status. For investors outside the US, that means another safety net has been withdrawn from US investments. So in this video, we look at removing currency risk from US stock investments by currency hedging. How can we hedge? What funds are available to do that? And what are the hidden costs? If you do find this video helpful, then please like it and subscribe to our channel. Now, what's the case for hedging US equity investments? Well, since 1970, there hasn't been a case. In fact, if you had hedged, you'd have underperformed. In the top panel here, you can see the value of the S&P 100, both expressed in sterling terms and in US dollar terms. And the sterling version of the S&P 500 has outperformed on average by about 1% per year. And it's not a coincidence that sterling's been weakening by 1% per year on average over the same period. Now, a lot of that weakening of sterling versus the dollar happened in the 1970s and early 80s, and that came after the end of Bretton Woods when there was a big adjustment in developed market currencies. Since then, you can see that sterling really hasn't moved that much, except for the shock of Brexit. So you could be forgiven for saying, what's the point of currency hedging at all? This has been hugely to my benefit in the past. And that's why recent developments are all the more shocking. We've seen a massive sell-off in the dollar. With the announcement of widespread tariffs, this was in 2025, this was Trump's Liberation Day, notice what happened to the US dollar. Now, historically, when interest rates are higher in a given country, that attracts capital and it pushes up the value of the currency. The US is no exception to that, as you can see. As interest rates increased in the US, so did the strength of the dollar. However, with Liberation Day, everything changed. Interest rates in the United States shot up, and that's because people were selling US treasuries, and at the same time we saw the dollar sell off against other major developed market currencies. Now, the reason why this is shocking is that the US was the bastion of safety. It was the safest of safe havens, both for its currency and for its government debt. So that transition for the US dollar and US treasuries from safe haven to risky is utterly cataclysmic. Now, one strange fact about investing in the US before Liberation Day for a UK investor was that it actually helped you living in a country with a risky currency. When risky assets fell and risk appetite fell, what we tended to see was people flocking to safe havens, including the US dollar. The net effect of that for UK investors was to reduce the fall in the value of their US investments. So investing in a risky currency actually helped us. It reduced the volatility of our investments during these choppy periods. Of course, it also hurt us on the upside as risk appetite recovered and sterling strengthened again versus the dollar. But the safe haven status of the US dollar reduced the volatility of a global index fund for UK investors. But that volatility dampening goes away if the US is no longer seen as a safe haven. If the dollar sells off alongside US equity, then we're being hit on both sides. We're losing money because the stock market's falling in the US, and we're losing money because the dollar's losing value. To see that regime shift in more detail, let's compare 2022 and the tech wreck sell-off with the sell-off this year in 2025. So what I'm doing here is comparing two funds. One of them buys US equity currency hedged, and the other one doesn't currency hedge. So what we see in 2022 is that currency hedging actually hurt us. And that's because the dollar strengthened as it was seen as a safe haven. Fast forward to 2025 and what we see is the opposite. The currency hedged fund actually outperforms the currency unhedged fund. So it seems as if the case for currency hedging your US stock investments is now much stronger. And that's if you believe that the US dollar has lost its safe haven status. If you do believe that, what are the funds which are available which currency hedge US stocks? Now, for our premium website members, we have this cheapest funds list, which has various categories: money market funds, global bond funds, and one of the categories there is US stocks. Now, notice the top four funds here are currency hedged. That's what GBP hedged means. Now you might think that would massively pump up the fee that you're paying for those funds. That's not usually the case. Currency swaps, which are the derivatives that cancel out currency, are usually quite reasonably priced. Although there is a twist in the tail, as we'll see. If you did want to get access to our premium website membership, you get access to lots of other goodies, such as members-only videos, almost 300 of those now, trackers which let you monitor markets and economics, and of course our chat application so you can ask questions of me or the community whenever you like. To learn more about that, just go to our website, pensioncraft.com/membership, and you'll find a link to that in the description below. Now the aim of those currency hedged funds is to give you a return which is equivalent to what US investors would earn in dollars. And the way the fund achieves that is to cancel out those currency movements with a currency derivative. Now there are lots of variations in how the fund manager approaches that, with the frequency of their hedging, but also the amounts that they decide to hedge. Some fund managers will simply hedge better than others. So for example, if we compare some of the largest currency hedged US equity funds, and all of these are accumulation funds, their total return, you can see that there's quite a lot of variation between them. So the line at the top of this graph, the best performing one, is the total return of the S&P 500. In an ideal world, our currency hedged version of the S&P 500 would track that index. But as you can see, many of the funds have actually fallen short of that. In fact, they've even fallen short of the capital gain of the S&P 500. But over this period, what you can see is that a fund like G500, this is from Invesco, has performed better than the rest of the funds. Now I've included UB0A, which is the fund from UBS, but that actually tracks a slightly different index. It's MSCI USA rather than the S&P 500. There will be a big overlap between those two indices, but maybe it's not a fair comparison. However, you might want to get that fund if you just want US exposure. Now, of course, that's not a recommendation of any of those funds, and it's always good to do your own research, plot the returns of the various funds through various crises, and work out a fund that works for you. However, there is a big caveat, which is a hidden cost in these currency hedged funds. Now, briefly, let's just go back to that cheapest funds page and focus on the expense ratio for those currency hedged funds. Notice that they're all quite low. However, that doesn't tell you the whole story. And that's because there's a hidden cost here, and that's never given to you in the expense ratio. The derivatives used to hedge currency have an inbuilt rate difference sensitivity. So if your country's interest rates are lower than those in the United States, then that's a drag on the return of your hedged fund. Conversely, if your interest rates are higher than the US, it's a boost to return. So let's take a simple example. Let's imagine that the return in US dollars for US stocks was 10% over some period of time. But if we currency hedge that back into sterling, what matters all of a sudden is the interest rate differential over that period of comparison. If, say, the dollar interest rate, it's usually the short-term interest rate, was 4% and the UK interest rate was 3%, i.e. UK rates were lower than US rates, the interest differential would have been negative, and that means when we currency hedge US stocks back into sterling, we'd lose a percentage point of return. Now, it's often the case that if you look at policy rates from central banks in developed markets, there isn't a huge difference, except for Japan maybe. If we look at rates right now as I make this video, the euro rate, however, is quite a bit lower than the UK or the US. The policy rate in the euro area is 2.2% versus about 4.4% in the UK and 4.5% in the US. So if you were currency hedging back into euros, you'd be paying away quite a bit of return in order to cancel out the currency risk. So really, if you are going to do this, be aware of that difference, but also what's likely to happen to that policy rate differential. Is it the case that your country is struggling with high inflation, whereas the US isn't? Is it the case that your country's growth is weaker than the US? For example, if we go back to 2016 to 2020, notice that there was a huge difference between the US policy rate and the UK policy rate. That's because the US was moving out of recession more quickly than the UK, and the Federal Reserve was hiking rates, whereas the Bank of England couldn't. And in turn, that meant that if you were currency hedging US stocks as a UK investor, it would have been a drag on return. But there are other drawbacks to currency hedging your US equity. The most obvious one is that the US dollar actually strengthens versus sterling. Personally, I'm not convinced that the US is no longer going to be a safe haven. Maybe it's because I'm just old and it's hard to adjust to this new regime. But personally, I think that the US will eventually recover its safe haven status as the volatility in policy that we see right now starts to abate, and potentially when new leadership takes over in the United States. Now, if it is the case that the US dollar strengthens and it becomes a safe haven currency again, then your currency hedge may not be such a good idea. Now, it's not the case that you have to go all or none with currency hedging. What you could do is just hedge half of your exposure to the US, or 60% or 30%, depending on what you think is going to happen to the safe haven status of the US. And I know for a fact that many of the PensionCraft community do just that. So I hope this has helped you understand how to hedge your US exposure, but also reasons why you might not want to do it after all. It's not quite as simple as you think, and you can't do it without having a view on short-term interest rates in the UK versus the US. Now remember, if you did want to learn more about this or any other investment topic, you can do that as part of our community. It's very easy to join. Just go to pensioncraft.com/membership to learn more. And as always, thank you for listening.